The Bank of Canada just cut its key interest rate to 3%, but we have to talk about some of the concerns in the article that goes beyond the headlines on the back of this incredibly overvalued market, with a lot of people touting that there's a bubble that could potentially burst, with Warren Buffett sitting on record levels of cash, no longer buying back his own stock. I want to break down some of the fundamentals to see, are we really overvalued heading into this earnings season, as Canada sits in this highly precarious situation. If you're on a path to financial independence, you damn well one day want to retire early, consider hitting that subscribe button, because we're bouncing between both sides of the border today, with first and foremost, interest rates get cut, baby. I mean, this is so good for the broader economy, but it is bad for the global purchasing power of our dollar, which we'll break down a little bit more in depthly. But these headlines don't really give us just cause into why stocks aren't rallying as aggressively. Though the TSX is up slightly today, it's mostly flat, so this didn't really give us the oomph a lot of people were expecting. But when you read into some of the articles here, you start to understand why, because basically the forecasted GDP growth will strengthen in 2025. However, with slower population growth because of the reduced immigration targets, both GDP and potential growth will be more moderate than was expected in October. If you read a little bit deeper into here, they do mention obviously tariffs being a huge concerning factor, with inflation around 2% in the economy and excess supply. Governing council decided to reduce the policy rate a further 25 basis points to 3%. The cumulative reduction in the policy rate since last June is substantial. The lower interest rates are boosting household spending, and in the outlook published today, the economy is expected to strengthen gradually and inflation to stay close to target. However, if broad-based and significant tariffs were imposed, the resilience of Canada's economy would be tested, and we will basically be following developments closely and assessing the implications for the economy's activity, inflation, and monetary policy in Canada. So this is one of the most intriguing times that we're in right now, because I feel like we're finally past the pandemic woes of the hyperinflated market we were living in, but the TSX is struggling to rally with spattered performance across each sector, with real estate actually getting hit of the hardest today, which kind of came as a bit of a shock. If I zoom my head out of the way here, you can see the real estate sector up here, where actually a lot of these stocks have been dropping fairly significantly, and I'm not sure exactly what that impact is. Even interest rate sensitive stocks like TELUS are starting to drop, but they did have quite a rally since the beginning of the year, so maybe this is just breathtaking, but I would have thought better performance knowing how their debt is highly sensitive to those interest rates. The Canadian economy, however, I think heading into its earnings is going to be incredibly bolstered on the back of what we're seeing still in the higher rates that are going to offer basically, higher interest income for the banks like we've seen in the United States. The United States give us some insight with their top bank earnings, and I think some of that will reflect onto the Canadian banks, because everyone was concerned on the renewals of mortgages at higher rates, so there could be some collapse in the economy. However, we're seeing higher activity in the broader real estate market across Canada, with the overall average sold price increasing over 12 months. The average 1 month is down, but these are slower periods in the real estate market, with Ontario seeing some of the most wild fluctuations next to Vancouver, which does make sense, but Vancouver is recovering. Edmonton has been seeing some massive spikes, over a 7% change over 12 months, because a lot of people are moving to the more affordable provinces out of the major metropolitan areas. However, let's zoom into Toronto itself, because that's where I personally live, in the GTA, and right now there were 310 new home sales in December, which was 46% lower year over year and 80% below the 10-year average, according to Atlas Group. 2024 will go down as a historic year. The December new home sales hitting their lowest point in nearly 40 years, the whole year producing the lowest annual since basically 1990, with condominium apartments, including units in low, medium, and high-rise buildings, basically accounted for 150 units sold in December, down 63% from December of 2023 and 86% below the 10-year average. This could be setting up for a massive correction in Toronto, but we're still seeing elevated home prices overall, and I think a lot of people are just waiting for the interest rates to continue to come down. Now, this could put some pressure on the banks, but honestly, I think this is going to be short-lived. I think this is a buyer's market where you should be taking advantage of the potential outflux of some immigration, and don't sit on this presuming that this is just the end of the real estate market here. I think Toronto is one of the most desired places on the planet to own real estate, so if you can get into the market, this might be your potential opportunity, and this still doesn't make me any more bearish, say, on the banking sector. So I am very confident that the Canadian banks are a great place to continue to park capital and are likely going to be a place of higher rates of return because a lot of the banks are still relatively suppressed. And if we can get past the level of loan loss provisions we're seeing, we could be in a far superior place for bottom line earnings on the back of record revenues. But again, you do have to keep some concern in your wallet. And I hope a lot of you have been, considering to diversify into the United States markets or the US markets because of the US dollar potential, because obviously with the US not cutting rates as aggressively, there's still a high demand for US dollars. And obviously cutting interest rates caused some concern, and we saw a overnight drop in the Canadian dollar yet again, as I predicted, on the back of these interest rate cuts. And now we kind of have to sit idly until we see what the tariff man is going to do on the broader economy. If he tariffs us, it's very likely our dollar will continue to sink, and I would just be a bit more cautious from that end of it. But still, I think there's some better opportunities in the Canadian markets over the US markets. As many of you know, I've been much more diligent on my stock selection, and I want to talk about this in comparable because a lot of people have been pointing out the Shiller PE ratio sitting at 38, but it's important to note that the Shiller PE, I think, takes the average of earnings over the last 10 years, so it's substantially higher than the general price to earnings multiple on the S&P, though the general price to earnings is a lot higher than it has been historically, and many of us are well aware that there's bubblish territory going on in the AI plays. We've seen some of this concern with DeepSeek that kind of shook up the competition's capex spending, and I think we're going to continue to see that volatility. So you gotta take a breath here and understand that people are continuing to see markets go up, and until we get kind of a black swan or something that can shake the market up like we did with the interest rate rise of 2022, these higher evaluated markets can go on for quite a period of time. But what I will point out is that there's some articles coming out showing that we are seeing good growth. We're just pricing in a lot of that growth into the future, right? Which only lasts for so long before we do get a correctional period. But it is important to note that the earnings, when you look at guidance here, basically for Q1, 6 of the S&P 500 companies have issued negative EPS guidance, and 6 of the S&P 500 companies have issued positive EPS, but we have not had a whole lot of earnings just yet. But the forward 12-month PE ratio for the S&P 500 is at 22.2. This PE ratio is above the 5-year average of 19.7 and above the 10-year average. But what's really, really important to note here, for Q4 of 2024, the blended year-over-year earnings growth rate for the S&P 500 is 12.7%. And if 12.7 is the actual growth rate for the quarter, it will mark the highest year-over-year earnings growth rate reported by the index since Q4 of 2021. Like I said, if we can trade at higher multiples with higher growth, it can be just, but what we might be seeing is some secular performance and secular kind of bubblish valuations going on with companies like Tesla. Obviously, Nvidia could be put in there if anything changes on capex spending. You have to be well aware that the multiples are expanding because of pull forward valuations that I don't think are justified, but it's not in a whole slew of companies. But if those companies start to deteriorate or something materially happens, the whole broader index tends to get hit with it. And that's where we kind of get into some of the curiosity when we're talking about mega companies like Apple that are starting to come down. They're starting to correct a little bit more because Apple was hitting a PE of 40, but it has corrected materially from where it was sitting. But we've seen the likes of Warren Buffett sell off almost half his stock portfolio and sitting on $325 billion in cash, which is a record high for this, Berkshire Hathaway, with not a whole lot of insight onto exactly what the war chest is going to be used for. But obviously, for Buffett to be doing this is highly peculiar. There's only one other time in Berkshire's history where they sold off this many assets and went to this level of cash, and the company has completely restrained itself from doing share buybacks, which could be a signal that they think their own stock is currently overvalued, considering the record level of buying of their own stock they were doing through 2020 all the way through to 2022 before the interest rate period took effect. So there's some real peculiarity going on with Berkshire Hathaway, and it's kind of crazy to think. I think, like I said, I feel like Berkshire is probably one of the cheapest top S&P companies just because they're sitting on about a third of their entire market cap in cash. They still have an incredibly large amount of valued assets, privately and publicly still held. So Berkshire is just probably going to be one of the most interesting case studies, and I'm shocked at how little people are mentioning how crazy the market territory we sit in is, considering the president's pumping meme coins. We're seeing crypto be incredibly volatile, and a lot of people feel like we're in a more risk-on environment, which does come with published concern, and you have to bake that into the stocks you're buying, because people are looking at small caps and stocks that have pulled forward incredible amounts of valuation, yet somehow they're sitting here trying to justify it when we haven't seen the growth pull forward enough just yet to justify any of it. So I'm on the fence of hyper cautiousness, as I've been mostly buying stocks that trade at lower multiples. I think Meta is starting to become unfavorable at its price to earnings, but maybe earnings can bring that down. I still think Google's the most favorable, but that's probably because of the risk with the fines that they're facing coming up this spring. We'll see how that impacts the stock if it gets proven to be a monopoly. But you have to kind of be careful with what you're buying and how you're buying. And global market ETFs, I think in a market like this for most people is more appropriate, but I do see value in Canadian stocks still. I am seeing value in some of the S&P top 10, but the broader S&P, I mean, we're all sitting here knowing that it is probably well overdue for a correction, but who knows whether that comes. You can't stop cost averaging because of that, but you want to maybe play into your investment thesis and just understand, making sure you have a cash emergency fund in case we head into a cyclical downturn would probably be prudent. But I'll pass that question off to you. I'd love to know what you think in that comment section below.